start with the simplest solution for life insurance at the lowest possible cost and only add complexity and additional cost if there's a really good reason for that. For most people, a combination of some employer-provided life insurance and some low-cost term insurance gets the job done most of the time. So that's where we're going to start. Today we'll talk about how to figure out how much life insurance you need, how long you might need that life insurance, and we'll talk a little bit about the pricing of life insurance. Let's start by thinking about why anybody might need life insurance at all. The number one reason is to pay for expenses that you want to be covered in your absence. So those are expenses that you're concerned would not be covered in your absence. That's typically within your family. So if you're not there and you're not earning an income, what bills need to get paid, what are the expenses that you're concerned that your family won't be able to cover without you. That's the number one reason. You might hear about a rule of thumb, like some multiple of your income as a way to come up with how much life insurance you need. We don't like to think about it that way. We like to think about in terms of how much cost we need to cover, which is a very different equation. Some other reasons that could come up is if you have a very large estate. At this point with the tax code, that's 23 million plus before the estate tax kicks in. So that doesn't affect too many people. If you have an estate of that size, there might be some other reasons for life insurance. If you want to leave some particular amount of money, no matter what, to some person or to some organization, some charity, if that's a specific dollar amount that you want to make sure goes to that person or the organization, that's a reason, potential reason for life insurance. But you'll notice that I didn't mention investing as a reason to have life insurance. Investing is a secondary characteristic of some types of life insurance. And those types of life insurance, in our opinion, apply to a few small percentage of the population for some of those reasons I mentioned that don't apply to most people. For most folks, basic term life insurance is what gets the job done. So that's where we start, that's where we spend most of our time. So how does it work in terms of figuring out how much coverage you need? We like to look at the grand timeline of life. So we have the beginning and the end. For the first, say, a quarter to a third of somebody's expected life, we are kids, we go to school, we get our first job. Nobody's counting on us for money, for the most part, during that period. So there's not really a need for life insurance during that stage. But at some point, maybe we have a family, maybe you have a mortgage, maybe other relatives start to depend on us because maybe they're aging and they're retired, etc., or maybe they have health issues. So at some point in life, we do have a need for life insurance. And that need is usually the highest actually at this early stage in life, because at that time, most folks also have very little in the way of assets. So if something were to happen to them, they don't have much in the way of assets to take care of those people and their family. So that's why we have life insurance. So that the amount of life insurance needed tends to start out high and the assets start low. Over time, assets grow. So this is, say, the portfolio of assets. And the need for life insurance starts up high and then declines over time. As your assets increase, your need for life insurance should decline. And ideally, you get to some point of financial independence where you don't need any life insurance at all because you have plenty of assets built up that you own that can cover all those costs that you're concerned about. So your life insurance need over your lifetime ideally gets to zero at some point. So the question is, when will you get to zero? So how long do you need the coverage? So the coverage period is called the term. When you hear term life, the term is the period of time that the policy is in force. That is the time period that the insurance company is on the hook for paying out a benefit if you were to pass away. So ideally, you align the term with the time it will take for you to become financially independent. So if you're aiming to be financially independent by, say, 65, and you're currently, say, 35, that is a 30-year period. Over that 30-year period, you've got insurance coverage, and at the end of that period, you don't need it. That's ideal. But you might also notice that your need for coverage actually declines over this time. So you start off with a certain amount you need, and you end up with a lot less as you go. A way to deal with that could be to layer term policies. So you could get a policy that lasts for 30 years, a policy that lasts for 20 years, a policy that lasts for 10 years. And that would be a way to try to match your insurance needs with your your insurance policies with your needs as they change over time. That's a little more complicated. Most folks don't go through the hassle to do all that, although it would probably reduce your cost significantly of insurance over time. Most folks just decide, okay, we've got 30 years till financial independence, and that's the term we'll go with, using the dollar amount of coverage that they need today. Nothing wrong with that, but do keep in mind that there's another way to do it by layering policies to reduce the cost over time. A more conservative approach would be to get a longer term policy to give you more time to reach financial independence. If you're highly confident that you're on track to be financially independent at an early age, say 55, then you could reduce your term to 20 years. When you reduce the term, the cost goes down because you're far less likely to pass away statistically in the next 20 years than you are in the next 30 years. The longer you're covered into your life, the higher the cost, because the higher likelihood that insurance company is actually going to pay out. That's why whole life, universal life policies are much more expensive in terms of the cost of insurance, because they're covering you out here. Whole life, universal life. They're meant to cover you as long as you live. So when you get a policy like that, the insurance company knows that they're on the hook to likely pay out a death benefit if you keep that policy. Whereas most term insurance policies lapse without a death benefit ever being paid. I've heard something like 90% or more that no death benefit is ever paid because the policy, people either stop paying on them or they lapse before that person passes away. And if people are choosing their policy correctly, that should be how it works out. So let's talk about getting coverage. The first decision is the amount. Let's say it's $1 million. That's what we calculate. That's the current value that would be needed to cover the costs that you have outstanding within your family in your absence, assuming that money is getting reinvested at some rate. Then we have the term. Let's call that 20 years. That's a 20-year, $1 million term policy. When you go to apply for a policy like this, keep in mind that discounting is not available in the industry. Like you might see some discounting on home and auto insurance for bundling. That's not how life insurance works per the regulations. One broker cannot discount the policy in order to win your business or because they like you more for any reason. It doesn't work like that. The price is the price. What matters is the underwriting process. The underwriting process is the method the insurance company uses to determine how much of a risk you are for passing away during the time when you're covered by them. And so that to the extent you're a higher risk, they're more likely to have to pay out, your premium is higher as a result. And of course, each company has a little bit different pricing and a different way of thinking about risk. And that's why we need to compare different insurance companies, but they all use the same basic methods for evaluating that risk. And I don't know if these are exactly in order of importance, but it's close. You've got age, you have, are you a smoker? You've got sex. Men are higher risk of passing away earlier than women, for example. And then you've got BMI, body mass index, basically height and weight. Then you've got medical history. There's more to it. There's family history that may come into play. There's some other factors as well. But these are the basic characteristics that affect the risk and the pricing of the policy. So, for example, I'm 40, and a policy of this kind would cost me about $111 a month at age 40. But if I were 5 years older, if I was 45, plus 5 years or 5 years younger, to give you a sense for the difference, 5 years older, the cost is 50% more. 5 years younger, the cost is 30% less. It's a big difference. So you can see how important age is. And if I were a woman, so if I were a female, the cost would be about 23% less, something like that. If I were a smoker, which I'm not, if that's a yes, that is plus 300%. 3 times the cost. I looked it up this morning. I was surprised. I thought it was more like double, but it's actually currently about 300% the cost. And if I have a super preferred rating, so I have a discount because of my health, that is something like 30% less, and it could be as much as 30 to much more expensive depending on where you fall on the range of the body mass index. Medical history could be all kinds of outcomes, including the possibility that the insurance company will not even make an offer because the risk of the medical history is too high. So the process is you apply for a certain amount over a period of years with a company that is proposing that their prices are competitive. You go through the process, they collect all this information, they come back, they give you an offer. If you like the offer, you can take it. If you don't like the offer, you can go shop with some other insurance companies before you accept a policy. So that is basically how it works. Again, the amount of coverage, very important. The amount of coverage changes over time that you need. So it's important to start with the amount that you need now, which is probably the most you'll ever need. Consider that it'll decrease over time. You could layer multiple policies to optimize for that. And the term is important too, because as I mentioned, at some point you shouldn't need any life insurance when you're financially independent. And then the cost of that policy will be affected by these factors, some of which you can control, some of which you just can't. And the name of the game is to try to align your personal risks with an insurance company that is more favorable towards those risks, including your activities like scuba diving or rock climbing or anything like that. Some insurance companies happen to be more favorable than others based on whatever characteristics they're looking for in their portfolio. I hope that was helpful.